There may be another downgrade coming for the banking industry. Fitch is warning it may be forced to cut the credit rating of dozens of banks, including big ones like JP Morgan.
News of the morning, though. Fitch, as you know, downgraded U.S. long-term credit to AA plus from AAA. Follows their rating watch negative call back in May and is the second downgrade ever by a major agency after S&P back in 2011.
Today, we're diving deep into a topic that has everyone talking: the potential banking crisis and recent U.S. ratings downgrades. This isn't just another economic news from every day to day. It's a critical news of the challenges America's financial system faces. So grab your seat, buckle up, and let's uncover the facts. But before that, make sure to subscribe to this new channel to see more videos about economy and interesting economic facts from around the world. So without further ado, let's start. Recent developments in the financial world have ignited concerns about an impending banking crisis. To shed light on this, we're going to discuss several key pieces of the puzzle. First, let's talk about Moody's and Fitch ratings downgrades. Recently, we have witnessed a series of downgrades that have sent ripples through the banking industry. Smaller lenders such as M&T Bank, Pinnacle Financial, Bach Financial, and Webster Financial have all faced official ratings downgrades. But the shockwaves didn't stop there. Even the heavyweight players like Bank of New York Mellon, US Bancorp, State Street, Truist Financial, and Northern Trust are on the watch list for potential downgrades. This is a significant red flag that demands our attention. Another prominent credit rating agency, Fitch Ratings, has issued a stern caution about the possibility of sweeping rating downgrades across numerous U.S. banks, including JP Morgan Chase. Yes, you heard that right. Even financial giants such as JP Morgan Chase could be at risk. Fitch Ratings isn't mincing words. They have expressed concerns that the U.S. banking industry is teetering on the edge of another potential source of turbulence: widespread rating downgrades. What's striking is that these downgrades could potentially encompass more than 70 U.S. banks, including some of the most prominent names in the financial world. Chris Wolf, an analyst at Fitch Ratings, has shed light on the gravity of the situation. He explains that Fitch's assessment of the industry's health was downgraded from AA to AA- in June. Although this action didn't trigger immediate downgrades on banks, it set the stage for a potential cascade effect. The implications of this potential ripple effect are significant. Imagine a scenario where major financial institutions like JP Morgan and Bank of America, among others, face a downgrade. These banks, currently rated AA-, could potentially be downgraded to A+ due to the recalibration of financial measures. This could set off a chain reaction that forces Fitch and Moody's to reevaluate the ratings of their peers. Wolf underscores that banks cannot be rated higher than the environment they operate in. If top-tier institutions like JP Morgan experience downgrades, the impact cascades down other banks, potentially pushing weaker lenders closer to non-investment grade status. As we process this complex scenario, it's crucial to assess the market's response. Shares of major banks, including JP Morgan, Bank of America, and Citigroup, experienced dips in the wake of these developments. The KBW Bank Index, which tracks the performance of banking stocks, also reflected market concerns. While the future remains uncertain, one thing is clear: these developments underscore the need for vigilance and a comprehensive understanding of the factors at play. As we navigate the complexities of this situation, it's important to identify potential triggers that could lead to industry-wide downgrades. One significant factor is the path of interest rates by the Federal Reserve. The trajectory of rates has a direct impact on banks' profit margins. A prolonged period of higher rates could exert pressure on their profitability. Recently, Fitch downgraded the United States long-term foreign currency user default rating from AAA to AA+. Fitch cited expected fiscal deterioration over the next 3 years and an erosion of governance due to repeated debt limit political standoffs and last-minute resolutions. This is a wake-up call, and we need to understand its implications. To help us dissect this situation, we turn to Elliot Hentov, the head of macro policy research at State Street Global Advisors. Hentov is no stranger to ratings downgrades, having been part of the team that famously downgraded the US government's credit rating back in 2011. The erosion of governance and repeated debt limit political standoffs have cast a shadow over America's fiscal profile. Hentov's insight paint a sobering picture of America's economic landscape. As we navigate in the potential banking crisis and the looming threat of widespread US banking rating downgrades, a new dimension emerges that further intensifies the situation: the surge in credit card debt. Recent data from the New York Federal Reserve sheds light on an alarming trend that has profound implications for the financial landscape. Americans found themselves increasingly reliant on credit cards to make ends meet, especially as they headed into the summer. The New York Federal Reserve's report reveals a staggering reality. Credit card balances have surged past the $1 trillion mark for the first time in history. This surge is the result of a $45 billion increase in credit card indebtedness during the April through June period, a sharp rise of over 4%. As a result, the total credit card debt now stands at $1.03 trillion, the highest value ever recorded in Fed data tracing back to 2003. This surge in credit card use is obviously accompanied by several negative consequences. Alongside this uptick in credit card balances, delinquency rates have also climbed. The Fed's measure of credit card debt for 30 or more days late has risen to 7.2% in the second quarter, up from 6.5% in the first quarter. This is the highest rate since the first quarter of 2012. It's a reflection of the challenges individuals face amidst an environment of inflationary pressures and uneven income adjustments. Some Fed researchers have pointed to two key drivers behind the surge in credit card debt: the inflationary pressures and increased levels of consumption. The effects of inflation have eroded the purchasing power of household income, which has declined by approximately 9.1% when adjusted for inflation and taxes since April 2020. This situation creates additional financial stress for consumers as the sustainability of their debt obligations becomes compromised. Furthermore, the rise in consumption has added to the growing burden of credit card debt, compounding the challenges faced by households. Against the backdrop of this concerning scenario, the potential implications for the banking sector become evident. The surge in credit card debt and rising delinquency rates add a layer of complexity to an already fragile financial ecosystem. As borrowers struggle to meet debt obligations, banks may grapple with increased default risks, potentially affecting their stability and overall health. Truly, to grasp the significance of these developments, let's take a closer look at the political backdrop. In 2011, during a prolonged and heated dispute in Washington over raising the debt ceiling, the U.S. faced a historic credit rating downgrade by Standard & Poor's. Fast forward to today, and we're facing similar parallels with political instability. But here's where the situation diverges. The political context in 2011 was distinct from the present day. Jim Reed, head of global economics and thematic research at Deutsche Bank, emphasizes that the 2011 downgrade occurred concurrently with a debt ceiling fight. Moreover, it was the first downgrade from AAA, causing an immediate and profound shock. The dynamics today are nuanced, and we need to consider the evolving economic landscape. Another crucial factor that comes into play is the role of central banks. The Federal Reserve's response to these challenges has significant implications for America's economic trajectory. The Fed has been raising rates and has pledged to maintain exceptionally high rates until at least mid-2024. This proactive stance aims to stabilize the economy and bolster confidence. As we steep into the new year, one thing is abundantly clear. America's economy is at a crossroads. The U.S. convergence of a possible new banking crisis, new U.S. ratings downgrades, and the surge in credit card debt has created a multifaceted challenge that demands our attention. In a nutshell, in this video, we have explored the potential domino effect triggered by rating downgrades, delved into intricacies of political instability's impact on credit ratings, and dissected the consequences of rising credit card debt. Each piece of this puzzle contributes to a larger narrative that underscores the fragility and complexity of America's financial ecosystem. That's why careful monitoring of market trends will be crucial for navigating this evolving financial reality. Embrace the challenges, stay informed, and be prepared to seize opportunities amidst the changing economic terrain. Well, now that you know more about the 2024 uncertain scenario for the U.S. banking system, don't forget to like the video and subscribe to our channel to see new videos about economy and interesting economic facts from around the world. And don't forget to turn on that notification bell, and we'll see you in the next one. Until next time, goodbye.